and welcome to the Altos Trading Live Strategy Session with Jeff Tompkins. This is your host, Richard Van Rich, and we are excited to have you guys with us here tonight. We missed you last week. So glad to be back in the saddle here. Got a new month, a lot of great information to go over tonight. If this is your first time on, you'll notice that your microphones are all muted. That's so we can hear Jeff and I talk, but there is a chat box and a Q&A box located at the bottom of your screen. So if you move your cursor over a little bit, you'll see that. Put questions in there, and we'll get to those throughout the evening and before we sign off at the end. If you have to hop off for any reason, don't worry. This is recorded. Be available in the members area later tonight and also on YouTube in the next following days. If you're watching on YouTube, please like and subscribe so you can see all of our videos as we're posting new ones every single week. If you have any questions about your account, access to Zillion, Trade Trend, any open trade alerts, anything billing related, email support@altostrading.com, and we'll get to those sometime tomorrow. So let me read the disclaimer before I bring on Jeff. Altos Trading LLC and Trade Trend Zillion software is intended to be used as an information service for subscribers, and it includes opinions as to buying, selling, and holding various stocks and securities. However, the publishers of Altos Trading, Trade Trend Zillion software are not brokers or investment advisors and do not provide investment advice or recommendations directed to any particular subscriber or in view of the particular circumstance of any particular person. Altos Trading LLC, including its owners, do not accept responsibility for any decisions made by subscribers using the software, and subscribers of the Trade Trend Zillion software or any persons who buy, sell, or hold securities should do so with caution and consult with a broker or investment advisor before doing so. All right, with all that being said, let me bring on Jeff. Jeff, you there?
Yeah, let me get my mic on. I'm here.
There you go. How's it going?
Good. Thank you. Yeah, welcome everybody. Good to see you guys all back on. Sorry we missed you last week. We were down at the International Traders Expo. Looks like I see a couple familiar names, so great to see your faces live down in Vegas. Had a great show down there last week. Let's see, and obviously a lot to cover tonight. We've got some new strategy topics to cover. Our market overview, since our last meeting together was in April prior to the end of that month. So we've got some things to review there, as well as our key levels. And then tonight we're going to be focusing in terms of strategy, we're going to focus on where to place your entry and stop loss orders. So we're going to talk about some different methods and techniques and strategies to determine opportune entry and stop loss order placement. And I'll elaborate more, but when I say stop loss, it might be a stop loss, but it might also be, a level to use a backup plan to make an adjustment to a trade. So we're going to focus on that this evening, and we'll incorporate some of the things we've talked about in previous weeks on our sessions into that methodology, and intend to save time for Ticker Roundtable tonight. So get your tickers ready to share, and we'll do some analysis on those this evening as well. And as Richard mentioned, he'll be in the chat helping out with any questions. So if you guys have questions, feel free to put those in the chat or the Q&A box throughout the session tonight. And then if it's something that Richard can answer for you as we're going through tonight's topics, he will go ahead and do that. If it's something that we need to address, obviously, to the whole group, we will pause and do that as well. Hey, Umechu, good to see you. I was hoping I'd see you in Vegas, but haven't had the pleasure to meet you face to face yet. One of these days. All right, so let's go ahead and get over to our charts. So there's a number of key things happening this week. We obviously had a sell-off today, a rotation lower off a key resistance level, and we're going to take a look at that here on the chart. Let me get the major indices pulled up. So in terms of like catalysts, fundamental catalysts that drove what we saw yesterday and today, some of it is still related to concerns around the banking sector. There's still some unease there. We've got, of course, this new issue with the debt ceiling. So there's some kind of macroeconomic fundamental issues that are causing the sell-off and the bearishness in the market currently. And then, of course, we've got Fed funds this week. So the Fed started their meeting this week, today, and wrap up tomorrow. fact, let's just take a look at the calendar real quick so you guys have that on your calendar and are aware. FOMC announcement. So this comes out tomorrow, and that is going to be, of course, the announcement of a interest rate hike, which is expected. So there's a lot of kind of risk off, sentiment in the market right now, largely due to, again, unease about the banking sector, the debt ceiling, and then we've got the Fed announcement, the rate hike tomorrow, which the consensus is a quarter point rate hike. So that's what the market's expecting and pricing in. So anything on either side of that expectation, which would be basically be no rate hike, highly unlikely, or of course, if that the highly unlikely instance that happens, the markets would take off to the upside. If it's a quarter basis point hike, which is the likelihood, we're going to see probably volatility with not a lot of directional movement by the end of the day tomorrow. If the rate hike is higher than a quarter basis point, then we're going to see the acceleration accelerate, or the sell-off accelerate, sorry. So that's kind of what to expect for tomorrow. So keep this on your calendar here, FOMC announcement. Let's see, let's get back over to our charts. Let's see if there's anything else I wanted to mention there. Yeah, I'm just looking at some different like CME stats. So they're saying 85% chance of a rate hike tomorrow. So again, very likely. But probably what they're going to be looking for more closely is often is the case, is Fed Chair Powell's the sentiment behind what he says in the meeting. So whether he alludes to further rate hikes down the road is probably going to be more impactful than the actual, on the markets than the actual rate hike itself. So if they, it's whether they have like a dovish or a hawkish stance. So if they indicate that, inflation isn't at the level they want it to be currently, then there is obviously a greater likelihood of rate hikes down the road, and that's going to be negative for the markets, or bearish, I should say. It might not be negative if you are bearish. Okay, so, and by the way, we have a lot of New Zillion members on with us tonight, so welcome to all of you. So we're going to look at the S&P 500 index in the Zillion platform. Just want to make sure we have got today's, yep. So let's expand this. So these are actually levels, because we met week before last, that are still in play, and that we talked about 2 weeks ago on our meeting. So if we look at this very strong horizontal resistance level on the S&P at 4,200, and then we've got our very strong support at 4,100. So we're still sandwiched between this 100-point range or zone on the S&P. And as we talked about 2 weeks ago, if we see markets rotate up into that 4,200 zone, watch for selling pressure. If we see markets rotate down into the 4,100 support zone, watch for buying pressure. We came down there today, looking at the low from today, we just breached it by less than 11 points with the low at 40.8972. But notice what happened here. We had buyers come in right around 4,100 and push us back up to a close at 41.19 and change. So these levels are, again, very critical, whether you trade the S&P or anything else, because everything's so highly correlated to the S&P and it has a broad market impact, that we watch these. All right, so for this week, and particularly tomorrow, depending on the market reaction to Powell's comments, and as I mentioned, even more so than the rate hike itself, watch to see if we get a close. If there's a bearish response, if we get a daily close below 4,100, my expectation is the acceleration lower will, or I keep saying acceleration, the sell-off will lower will accelerate. So that's really what to keep an eye out for tomorrow. But these are our key support and resistance levels for this week. So there's our support and there's our resistance. And since as of today, we are on today's high-low range, we encountered support. Resistance, although we didn't get quite up to 4,200, we got close to it, right? And back here and here, we saw sell-offs. Now, the last two times we were up around this 4,200 level on the S&P, we also rotated lower into the support zone. On top of that, we had major sell-offs when we broke it. So this is why we want to really be cognizant of this 4,100 level, because if we get it closed below again, and again, we need closes, right? Here was the close below, and kind of a side tip here, look to see, because like on this day, let's see what the close was, 40.90, so 10 points below. We want to see if we get a close this close below century mark 4,100, wait for the next day, right? So we now have two closes below. And this is what often traps people. We had a bullish reversal candle, but it closed below the 4,100 century mark, big sell-off, right? So this is what we want to be watching for this week to give us direction of the S&P and the broader markets. So if this happens again, like we saw back here in mid-August and then mid-February, we need to position ourselves, whether it's protecting long positions, hedging, or initiating short positions. That's what we're looking for on the S&P. So this is more short term. This is for this week, or as long as we remain in this 4,100 to 4,200 SR zone, support resistance zone. As we look at more of a medium to longer term perspective, going to a monthly chart of the S&P. So we're looking at the S&P monthly here. Each candle is a month. We look at April, right? We've rotated again off the 36-month moving average, which has served as a very strong dynamic support level. So we've had a lot of price action around here since we had the bear market reversion into this 36-period moving average, which for those of you who are new with us is a very important historical mean reversion point for the major indices. So when we see the S&P mean revert into that, what we're looking for from a bullish perspective is for price to make moves up, to the upside off this 36-period moving average. In order to do that, it's got to break significant resistance. So oftentimes when you go up in time frame on a chart, like in this case, we went from a daily to now a monthly chart, it's easier to spot these resistance levels or support levels, but in this case, resistance. So we see, as we just looked at on the daily chart, 4,200, very important century mark for the markets right now. So if we look at past price action here, we see many months of support and resistance, right? Virtually every month is reacting in close proximity to this level until we get down to our 36-month moving average, right? This is not a resistance. This is a dynamic support level. So it's not a horizontal static level. It's changing as the monthly candle price action changes. So we're finding support here. So we're really wedged in this zone. And by the way, the 36-period moving average coincides with our millennial mark 4,000, just 16 points above. But we're wedged in this zone, right, that is getting tighter and tighter. So if you look at this 36-month moving average, our 4,200 horizontal resistance, we're getting wedged here. And eventually it's going to have to break out. Most likely, it's going to break out to the upside. That's the greater probability. Okay, but for confirmation of that, we need to see a monthly close above 4,200. Okay, so again, this is more medium to longer term. And it's important that we analyze price action and key levels from multiple perspectives. So not just from a short-term, perspective, like within a week, for instance, or within a day, but also from medium to longer term perspectives. And that's what this is looking at here on a monthly chart of the S&P. So notice how this month already, we're only 2 days into the month, there we are, bumping up against resistance and seeing a sell-off. The banking, all the fear behind that, the SVP and like other banking failures that have ensued is not really getting worse. If anything, it's stabilizing, but there's still fear and uncertainty, right? And so it doesn't take, when we think of catalysts and why do markets go up or down, there's kind of a baseline level of fear or optimism, right, or greed. And it's kind of like a scale. It just depends on what's tipping it the other one way or the other. Well, right now there's a few things tipping it bearish. And when that happens in conjunction with a key level, we see a sell-off, a key resistance level. When it happens in conjunction with a key support level, we see a run up in the market, right? So currently we're seeing bearish sentiment at a key resistance level. Okay, so our short-term sentiment is bearish. So going back here to the monthly chart of the S&P, we need to see a monthly close above 4,200. That gives us a medium to long-term bullish bias. So that's the confirmation we're looking for to get out of this wedge that we're in. Okay, so those are all key levels. And again, key resistance at 4,200 on the monthly chart coincides to key resistance at 4,200 on the daily chart. Here we're just also looking at dynamic support at the 36 period moving average or 36 month moving average, right? So let's go back over, and I am going to pause here for questions in just a second after we look at the tech sector. So we're going to look at the NASDAQ 100 ETF, the Qs, right? And a similar picture here. So we've got very strong resistance. This one's a little tricky. So when we look at pivot highs, the daily high range on some of these previous daily candles, I want to point this out here too. I will just a second, but we actually could consider this somewhat of a support level based on today's price action, right? So yesterday we had the breakout. Tech's kind of counter to what we typically see. Tech's actually, faring better than the S&P. It's usually the other way around. All right, so we broke that yesterday, this resistance level, which on the Qs resides just right around 321.50. Broke it, came back down, retested, but we had indecision today. So likely, just like the other major indices, tech is there's indecision, there's reaction to key support and resistance, looking for direction tomorrow from the Fed. So watch this. This is kind of, rarely do we mark a level as support or resistance, but while it's technical support based on today's price action, I'm treating this kind of as a support / resistance depending on what happens tomorrow. So if we get another close above this level on the Qs tomorrow, I'm going to feel more confident it's a support level. If it breaks and gets a close tomorrow below, then I'll treat it more as a resistance level. But if we look at past price action around this level, right, prior support, spent a few weeks above that level before breaking. Major sell-off here. And not saying we would expect a sell-off of this magnitude if we break this this level again to the downside, but something to be cautious of. If we do break tomorrow to the downside, keep a close eye on like 314, 315 as support. And we'll leave it at that on the cues, because I think if we do break to the downside, this will, for this week, before we meet again next Tuesday, will serve as a strong support. All right, and then lastly, we need to look at the VIX, the CBOE Volatility Index, to see what it's telling us. So we saw a big spike in volatility today, intraday, that paired itself and closed kind of midway in the range. So we actually closed 1778, so relatively low on the VIX still, but we had a lot of volatility. I mean, the VIX was up, it closed up 10%, but at a point it was up over 20% off the low. So 19 is a resistance level to watch on the VIX, and 20. Okay, so we see the VIX, it tends to spike around uncertainty, like an upcoming FOMC rate hike announcement. So this is probably correlated to that to a degree. We have formed a strong base at 16 as support. So what are we looking for tomorrow? If there's a negative market reaction to the FOMC rate hike and Fed Chair Powell's comments, we'll likely see another big spike. Whether that continues, to me, depends on if that spike closes above 20. So if we get a VIX spike again tomorrow, and it, unlike today where we paired the run up and closed halfway roughly in the range, if we get a close above 20 tomorrow, then I'm more aggressive on the bearish side to the downside. This is where I would be adding short positions, being more aggressive with my hedges for long positions, so forth. If the VIX can stay below 19 or 20 by tomorrow, then do the inverse correlation. We'll likely see the markets, like on the cues that we just looked at, we'll likely see that level that we mapped out hold as support. And we may see S&P rotate back up into that or even past the resistance level. Okay, but if we spike up and close above, then those resistance levels that we just looked at on the indices are going to be much more likely to hold, and there's a greater likelihood we're going to see a sell-off continuation. All right, so that was a lot, I know, but very important. We have some very critical levels to be watching tomorrow, as well as obviously the reaction to the Fed. So we'll go ahead and pause there before we get into our strategy for tonight and see if there are any questions.
So regarding the VIX, in the past you've mentioned that sometimes when you see VIX get down in that 15, 16, 17 range, you sometimes look at maybe doing like a 30-day expiration kind of call on it. Are we in those types of conditions, you think, or is it
right, like doing a hit, like often I'll put on like a bull call debit spread, which actually I do have a bull call debit spread on right now that's far out in expiration. It's a couple months out, just because we've reached such low levels of VIX. It actually was in profitable territory today just from today's one-day spike, but not enough for me to close it out. I'm hanging on to it. But what I really look for is, and this is when roughly around when I put it on, is our buy signal. So if you use Zillion or if you're a trade trend user, I look for buy signal. So this one came in on April 20th on the VIX below the 20 level. So this is, I think, roughly where I put this bull call spread on, which makes money if the VIX spikes up. So that came in again, April 20th. It triggered on the 24th. So that was last Monday. And then we've gotten, we got a spike last week, but a big reversal back to the downside, and then another spike today. but yeah, these are good trades to put on when you get a buy signal. The buy warning again, April 20th. That's confirmed, right? Didn't confirm till the 24th, 4 days later. And then around like a market, a period of uncertainty in the market, or an announcement like FOMC rate hike, or anything that might be kind of a binary event that could cause volatility to spike. Because today's spike was really more anticipatory. Like we don't know what the Fed's going to do. We don't know what's going to happen with the debt ceiling. There's kind of some of these unknowns in here that are causing fear, but there's no real actual final catalyst that is what would actually really result in a spike like we saw like back here in March. So generally when we're at low levels on the VIX, the likelihood of a spike increases the longer we're below that, because eventually volatility always spikes, just a matter of when, and it always comes back down. So those are kind of, as much as I hesitate to say there's any inevitability in the markets, if there are, that's them. Volatility is always contracting and expanding. So when it expands, we're going to see a VIX spike. When it contracts, we see the VIX retreat back down to lower levels. So if you use a contrarian viewpoint, which is really the correct and accurate way to do it, is when the VIX is low, we're at higher risk of a market sell-off and a spike. When the VIX is high, it's going to eventually have to come down. So we're at we have a greater probability of market stabilizing or even moving up. So again, the inverse correlation there is important to understand and incorporate into your trading and investing decision. But yeah, this is currently, because we did get the VIX close right around the triggered entry price from the buy signal back on April 20th, for me, an appropriate level to initiate, what we would refer to as a bullish strategy on the VIX, which, due to the inverse correlation, is a bearish market perspective, where we would, put on a call spread, call debit spread, or buy a call, or something that would benefit or profit from a spike in the VIX.
Cool. That's all I got.
All right. Well, if you guys think of anything else related to the markets, feel free to jump in and let us know. So tonight I want to focus on determining how to, accurately identify entry and stop loss levels, especially as markets become more volatile. It's really important, and it really ties into what we just did on our market analysis. Where we kind of always start our trading plan. Looking at the major indices, mapping out the key levels, determining what volatility is doing and how it's correlating to those key levels. Those are really important first steps in formulating our trading plan or our investing plan. And it ties into that. So what we did is really what I use to, in particular, identify like a level where and we're going to use the term stop loss, because many people may use it as that, where if they enter a position and it moves against them, that's where they would get out of the trade and cut their losses, or manage their risk. But I may use it for that purpose. I don't particularly like using stop losses. I much prefer using backup plans to make adjustments. For those of you who have been with us for some time, you know that about me. And I typically do not use a stop loss. I'd rather manage my risk going into the trade by scaling in and have a backup plan to make adjustments to that trade if it encounters difficulty. So that would be another way that I would use this method. But the kind of the end result, or the end result of the analysis, is the same. We need to identify a level where it makes sense to either get out of the trade or make an adjustment to it. And so I use a combination of static and dynamic support and resistance. And I don't just use it for trade management, for like a stop loss or a trade adjustment level. I use it for entry as well. So we're going to kind of look at both sides of that, because we're also going to talk about entries. So we're going to kind of do it a little bit backwards. Like we'll start talking about the stop loss level, and then we'll look at the entry as well. But let's actually get out of the VIX here for a minute. Let's go over to, let's just use the S&P for time being. Oh, let's actually look at the Russell. We don't look at the Russell all that frequently. Okay, so anytime I take a directional position, I need to have a backup plan, a plan B. Where do I either get out of that trade if it moves against my directional, bias or my whatever trade I put on, or where do I make an adjustment to it? And what I do to determine that is what we could call like a supply or demand point. Where is there buying or selling pressure on a technical basis, like a price level, and probably like a fundamentalist would argue, well, it's kind of the, I guess the disclaimer, like past results don't indicate future performance. And while it's in some ways a valid argument, it's easily squashed by looking at a price chart. So if you like to zoom out of this Russell chart, right? So if I can spot this like very, very easily. Obviously, it's in hindsight. Doesn't look very straight. Let's straighten this out a little bit. Right around 1920. So what did I notice here? Well, support, resistance. This, if we zoomed in, kind of a combination of support and resistance. Now, we don't have to touch an exact price point. We want to look for price action and, in particular, key reversals nearby, in close proximity, right? That would count for me. This would count for me. As we get more granular with the trading plan and levels, I would be looking at these highs and creating more of a zone. But for now, step one is I'm just trying to identify very obvious levels. Okay, so if I took a short position, because hey, look at this. There's a sell, very nice sell signal on the Russell. And it was right. In fact, I just randomly pulled up the Russell here, but I'm noticing something very interesting. This is like a perfect example. I'm going to zoom in here in a second. But for now, so we got a sell signal, beautiful down move. Why was this such a great sell signal? Well, it was off of a resistance level, but it was also off a support level. There was support. So then I'm left with the question, do I give the weighting to support or resistance? So my next step, once I've identified this level, and again, what I'm looking for here is just very obvious. So the best way to do this for you guys on your own is as you practice and do the exercise in your own charting platform, just zoom out of the chart, go back, go to a daily chart, go back like a year or two or more. Just if it's not obvious, because again, we'll get more granular, but for now, we're just looking at very obvious. This is very obvious right here, this level. Support. So we want to see both support and resistance, right? So we see that. But then which do I give more weight to? Well, there's two things. Because we have support here, right? Back in early 2022. Broken becomes resistance. Broken here, minor support for a couple days, broken again, retested, back down, back up, back down. Right? Broken again, minor support again, broken. So as I kind of just did that analysis very quickly, it's telling a story. Like, what am I looking for? Well, I went back to over a year to early 2022. That's really when this level started, right? Did price spend more time above 1920 or below? Well, obviously, it spent much more time below than above. So is this level 1920 support or resistance? Well, it's both. But if I had to choose one, I would call it resistance. So that's the one thing. Did it spend more time above or below that level when that level started? So we have an answer. This is resistance. But it's not a definite answer. The second thing we need to determine is what is current price, because that's kind of going, we're looking back, in this case. What is price currently doing? Where does it currently reside? And in which direction, shouldn't have actually deleted that. In which direction is it coming from that level? Okay, well, price is below. In fact, now it's far below. But back here, when the sell signal came in, it came in below this level. So we broke prior support, retested. I mean, this couldn't be a better signal. This is exactly what I look for. Retested, and then we got the sell and a big sell-off. So those are the two things we're looking for. Did it? I'll kind of add one little nuance in there. So here's another one. I didn't circle it, but we've got a few levels of support here until it broke in early April and transitioned to resistance. A couple of brief breakouts, right? But when we look at the rotations to the downside off 1920, there are many, oh, sorry, that was a breakout. There are many more than support. So I kind of look at the balance, like what is the ratio of rotations higher versus rotations lower off that level? So that's kind of the final component. So obviously this is, if we give it weighting, because it is both a support and resistance level at 1920, we want to know, because we're trying to give ourselves an edge and a higher probability of being successful in a trade. So our higher probability, and this actually emphasizes that if you look at these periods right here, they didn't last very long, right? They didn't make it very far before. So this is what we kind of refer to as retail traps. This is where a lot of traders get trapped with false breakouts. Okay, how do you avoid the trap? With what we just went over. Okay, would I have taken a buy signal here? Absolutely not. That's a low probability trade. We didn't get a buy signal, but if one came in, I would be very cautious. Why? Because this is a stronger resistance level at 1920. It's more of a resistance level than a support level. Okay, and that proved to be the case here on the sell signal. So let me clear this out and zoom in here, because there was another signal here, and although it didn't trigger, so this is one of the beauties of our algorithm, is it can also keep you out of bad situations. And this is where we're going to get into the entry strategy. Right, here's a buy signal here. Would I have taken this? Even if I had put an order in, you can see there was no confirmed entry because the entry price would have been above this candle on March 3rd. We never traded above it. So the way our algorithm works, it kept us out of this bad trade opportunity. But nevertheless, I don't want to take a buy signal right into a resistance level, right? Or near a resistance level, because they often result in false breakouts. That's what happened here. Broke out, trapped a bunch of people. The previous move was to the downside. So this is always going to be more likely a retracement and a continuation than a full reversal. So if you want the higher probability trade, you wait for all the trap traders to get tricked and the reversal. Now, that doesn't happen every time. This could have just as well moved up. And for that, hey, you miss an opportunity. But over the longer term, in the aggregate of all your trades, you're better off. So that's a demonstration of that here. So we get the sell signal. This was actually the one that I'd want to take because it's off of a strong resistance area, right? The weighting is towards resistance. So once we break that, not only do we have a higher likelihood of a sell-off, we have a higher likelihood of a larger magnitude sell-off, not like a little weak breakout like this. Okay, so that's how we use these levels. Now, stop loss, right? What if this didn't play out the way it did? What if this didn't pan out? Well, that's the importance of mapping these levels. So actually, let me just zoom out here a little bit. Okay. All right, so 1920, a little bit too much. All right. So if we take a short position here and there's a double trap, like it goes back up or something, then at least we know where our SR line is, right? It's at 1920. So we can, if we, in this case of the sell signal, took a short position, we want to place our stop, whether it's get out of the trade, take a loss if we're wrong, which I don't like using that term. It's not if we're wrong. It's not about being right or wrong. It's just the market didn't do what we expected, right? We're not wrong. We were right. We did the right thing. We made the right analysis, but the market didn't agree. Okay, we can't control that. But what we can control, so we have this level, and once we have that mapped and we initiate a trade, a directional bias, in this case to the downside, where do we get out or make an adjustment? Well, I want to put it past that level. So in this case of a short signal, I want to at least get it past 1920. So I'll usually use a swing high level. So I'll look at a point where, let's actually zoom in here. We had a swing point, and a swing point is basically a candle where, in the case of a swing high level here, the previous two candles highs were lower and the following two candles highs were lower. And this is what we call a pivot point, right? So we have two candles, and it doesn't matter what time frame you're in, but you have two candles with lower highs to the left, two candles with lower highs to the right. It would be the opposite for a swing low point, right? We have two candles to the left with higher lows, two candles to the right with higher lows. That's a swing point. Okay, so that is a very, because we're incorporating price action and key level. So we're using actual price action levels and prices off the candle. Okay, so we're putting our stop here, and we're making sure that that price is above, in the case of a short trade, above that level. So we've given ourselves really two layers of safety here. But it goes beyond just being a layer of safety. It also reaches the point of being like a confirmation that it's probably not going to work. Because if we do go back up to that level, okay, and this is an example of that, what happened here, where again, probably a lot of traders got trapped, didn't know that this was actually a weighted resistance level and not a weighted support level, which again, a lot of retail traders probably looked at this as a weighted support level, but it was a weighted resistance level. We just demonstrated that. So they get trapped. So that's probably what happens. And when you do, even if you got trapped in this, we at least know where to get out. So like the trap here stops down here, right? So we use a swing high level off the candle, as I just demonstrated, past that support or resistance level, in this case, resistance. Okay, so that's the technical level that we use either for a stop loss, get out of the position, we're going to cut our losses, or I'm going to make an adjustment to this. Maybe I made a very short-term trade decision and it didn't work out immediately, but I have other reasons to believe it will down the road. So I'm going to hedge this for now, put on a bullish hedge to hedge the short. And then if so in that case, I'm hedged if it continues to move against me. If it moves back down below that weighted resistance level, I have strong conviction that we're going to get the sell off. I can take the hedge off and likely take profits on it and then keep the short open. So that would be like a very basic example of adjustment on that type of analysis. So that's how we use the level, right? And place our stop. So I'll pause there, see if any questions, and we can talk a little bit about entries and then do some ticker roundtable.
Let's see. Just a lot of positive. Joseph was saying was really insightful talking about that trap on the Russell.
Thanks, Joseph. That happens a lot. And I would encourage you to practice looking for those. So that, again, the first step is draw the support and resistance and then look for the traps and see where do the weighting. Actually, before you look for the trap, do the weighting. Is it a weighted support level or a weighted resistance? And then, kind of mentally go through, like if I took a long trade off of this, because it's a weighted support, where would I put my stop? If I took a short trade because it's a weighted resistance, where do I put my stop? And then go back and look on the charts and see where you'll see it. It becomes very clear, like where people probably got trapped.
Yeah, that's really important to point out. And I think you guys, I would encourage you to watch this more than once, because Jeff's talking casually about this, but this is really kind of the key to using Zillion and learning the signals and really learning exactly when to get in and when to get out, and which trade setups really make the most sense versus which ones you should probably wait and hold off on. So I think it's very insightful, Jeff, to explain this to all the new folks here.
Yeah. I mean, it's so powerful. It's just like, and if you can do it ahead of time, like it's greatly reduces like the guesswork and like self-doubt and things that we all face after we get into a trade, because we have that level in place. We don't have to second guess ourselves. So it's really important, again, whether it's used as a true stop loss level or a level where we need to change our stance on the trade and make adjustments to it, whatever the ultimate action is that we take based on it, we need to stick to it and know where it is. I think that's kind of all I wanted to say on that. But any other questions there on that? We'll briefly talk about the entry, but it's since we've kind of laid the fundamental methodology of this approach, we can do that just in a few minutes because it's based on the same principle.
No, that's all I got for now.
All right. So for those of you who are Zillion users, that you use our Zillion platform or our indicators like trade trend built in here, this will make sense to you because this is how we've designed the algorithm. So when we get a forecasted directional move, whether bullish or bearish, let's just say bullish, the entry needs follow through, right? It needs to go up to the entry price. So when we get, even if you don't use Zillion or trade trend, this principle can be applied to any entry, right? So if you're using any indicator or to get into a trade, you have to initiate it, right? You have to enter the order and have it be filled. So we only want to do that, and reason being we don't want to get whipsawed or trapped, is we need follow through of the directional movement. So this might not be like super applicable to a non-directional trade strategy, like an iron condor, for instance, or there's some strategies out there that are market neutral or non-directional. But if we're placing a trade with the expectation of a directional move, we want to see early and quick follow through with that move. Otherwise, it's probably not going to work out. Yeah, and so that's what we do. So like in the case of a buy signal where we see the white diamond below the candle, that's our buy signal. The entry is going to be above the candle, and our algorithms provide that up here on the chart. But if that follow through doesn't occur, and based on a lot of statistical testing and things, we want to see that follow through within the 3 candles after the signal, then cancel the order, wait for the next. So that's kind of one thing. So the entry is really, based on follow through of the directional move, but then where it really ties into the stop or adjustment level methodology that we just covered, we don't want to take a buy signal into or even right around a resistance level. We don't want to take a sell signal right into, or when I say right around, like if we get a close near that. Because even though we're looking at specific price levels, I treat them as zones, right? If you look here, for instance, right around 1800, century mark on the Russell, okay, 1800. Okay. To me, that's a pretty obvious resistance area. Look at that. Okay, price doesn't want to get above 1800. Did it get above 1800? Yes, it did. Look at all these days, we broke 1800, just not with any sustained bullish breakout. Again, trap. So I don't say, okay, price has to exactly touch 1800. I'm looking at the zone, right? I'm looking at exactly what we're looking at here. Is price finding support or resistance around that level? Okay. Why do I use 1800? Well, market participants, I think it really relates to human psychology. We tend to focus on easy round numbers. It's just the way our brains work. So what's so special about 1800? Probably nothing, right? You just randomly ask like the most knowledgeable, well-connected, intelligent trader and investor out there. Go to Warren Buffett. Ask him, what does 1800 on Russell 2000 mean? He's going to give you a blank stare. It doesn't mean anything, but it's a level that is attracting selling pressure. And it doesn't have to be right at 1800. But it's a big round number. So it's not a coincidence. You see this around lots of big numbers. Let's go to 1900. Hey, what a coincidence. Why were there big resistance areas? Why did all these sellers come in at 1900? There you go. Okay, so big round numbers. But then again, to reiterate, it doesn't have to be right at that level. We're just looking for price action around there. And is that price action bullish or bearish? Well, in the case of 1800, going back to early March, it's bearish, right? So these are good selling opportunities. That's a weighted resistance level. Okay, so here's an example. There is a sell signal right off 1800. The entry for confirmation is below the price below that level. And what happened? Boom. So that's the entry. We need to, number one, whether you're using Zillion or our trade trend indicator or your own indicator, and you're confident that it's giving you accurate advice, you don't want to stop there. What is whatever signal it's giving you, buy or sell, what is it? How does that signal relate to the context of the market structure? Okay, that's taking it an extra step beyond what most people do, who they just take an indicator and blindly follow it. We don't want to blindly follow it. You want to take it in context of the market structure. Here, the market structure is bearish into the 1800 level. That's our high probability trade. Right down into support. Again, support zone here. That's century mark 1700 to 1725, quarter century. So that's what we're looking for, okay, for entry. And it doesn't stop there. Once we get the entry, while we know where our stop loss level or our adjustment level is, if we, because it's inevitably going to happen, things don't work out 100% of the time. So we have the backup plan for the stop. But we don't stop there. We also need to have an exit plan for profitable trades, right? So same thing. Where do we get out? Well, if I take a short trade here off of the 1800 level on this sell signal, what am I going to be looking for? Support, right? So we got sell signal off resistance. How long do I hold the trade? Well, for me, I don't hold a trade based on time. I hold it based on market variables, right? Key being support. So if I take a short trade, where am I likely to encounter that trade stalling out or reversing on me at a support level? Roughly around quarter century mark, 1725. So if I didn't take a trade off the sell signal, by the way, but if I had, that's where I would place my profit target level, or where I would start to scale out of my position. Okay. So tomorrow we might see this break. If I scaled out, I would hold on, because then I'm looking at support down around 1650, half century mark. If I just sold out, then I'm out. That's a nice profit from 1780 all the way down to 1725. But we need to use this methodology, and this is what I incorporate into not just entries, but stop loss and take profits. That's what I use predominantly. It depends on the strategy I'm using, like whether it's options, derivative-based futures, whether I'm directly trading shares of the underlying. I may use our trailing stop levels. But even if I'm, like, for instance, using a trailing stop to manage, which I might do in the case of this was a really good buy signal with good trailing stop levels off support, right? I would use those potentially as well. But I'm still, and this is actually an interesting case too, I'm still looking at where I might encounter resistance, right? 1900, obviously very strong weighted resistance level. What happened here on the day, the trailing stop took us out. It continued running up, but we had 2 days of a move off 1900 all the way down into 1800, 100-point loss in 2 days. Okay. Trailing stop got us out around 1850. Could have just used the 1900 level as well, right? Obviously, high probability of resistance and reversal, weighted resistance level. So, the overall principle here is it applies to entries, stops, and take profits. It's kind of what I wanted to drive home. All right, so any final questions on how to place, in terms of, like, not just entry, but trade management, stop loss, adjustment levels, take profits? Then we'll if you guys want to stay on, we can take some ticker roundtable as well for a little bit here.
Let's see. I got no questions coming through yet about the placement. You covered it really well.
Okay, great. Glad to hear that. Yeah, if you guys want to take a look at any symbols together, if you guys want to run some analysis, we can do that. Put those in the chat or the Q&A box.
Let's see. Robbie asked for SPX, but you already kind of covered that.
Yeah, I mean, I can just run, yeah, we did, like, the key levels and stuff. Just real quickly though, again, there's in the S&P right now, we're in a bearish conditions because we've rotated lower off of resistance. But we also I have to consider FOMC tomorrow. So for me, I'm kind of waiting till close tomorrow to see how market reacts at this resistance level that we just looked at. But more so kind of the 4,200 level. So that's what I'm watching there. If we continue to move lower after FOMC tomorrow, my expectation is that will accelerate.
Let's see. Ari's asking for IoT.
IoT. Is that a stock?
Just had a ticker in there. Let's see. We can look at another one while you.
Okay, yeah. Why don't you find out from him, and then we can come back to it.
Yeah, let's see. Tesla.
Okay. All right, so this is always a crowd favorite. Okay, so again, I'm just zooming far out of the chart here. We did get a buy signal yesterday, triggered today. Where's price? Well, it's below key resistance. All right. not strong resistance. So at least going back to, because I've zoomed out to early 2022. So we're looking at, a year and 4 months of price data. This is actually a weighted support level. So we got, boom, right? It did break. So when support breaks, it transitions to resistance. So we're seeing that occur here. So we're encountering some resistance kind of right around, 165. But this is still, to me, a weighted support level. So here, I don't want to take this buy trade into this level because it came in below. But this could, if we can break roughly, 165, break out of this level with some conviction and get a bullish close above, then I'm taking a trade with price above a weighted support level, and I've got a much higher probability trade. And not only that, I've got a very obvious stop loss level, right? Below my swing low past the 165. So if we can break through, while I might expect a retest while I'm in the trade, my ultimate expectation would be an acceleration of the upside. So right now we're still below this level, even though it is a weighted support, not resistance. So I could take this buy signal if on the condition we can get a daily close above that level. If we can't get that, then this may, this level may end up holding as resistance.
A couple votes for Meta, META.
Right. Oh, that's odd. I'm not getting data for it. Let's go over to here. All right. So looking at Meta, we've got
Yes, SPX.
SPX. I was going to say, I was like, that can't be right when I looked at the price. There we go. Okay, so we've got, zoom in a little bit here. Yeah, it's not going to give me the right. All right. Okay, so I want to look at 200, 220. When I see big gaps like this too, I want to look at those. This is probably pretty far out of reach. That's a century market 300. All right, so again, did get a buy signal, but this is weighted resistance right here. Okay, sell off. We don't have this level of support. So this is weighted resistance. So if we get a breakout, I'd be cautious. Could be a false breakout because it's weighted resistance. And again, don't like the buy signal into that level. For me, like if I were to play this, I would either wait for a potential breakout or a sell signal off this level. And again, that level is right around 250, 248 to 250. That's how I'd play that one. Again, not intended to be advice, but just kind of giving you an idea of the levels I would look for and how I'd play that.
I was gonna say, while you're still in TOS, I think IoT is not in.
So it is a stock. Is it Samsung?
Yes, yeah, that's it.
Okay, cool. All right, not familiar with this name. Let's take a look. So again, I'm very zoomed out here. I'm just looking for obvious levels right around 18 there. Okay, so this 18 level looks significant to me. Price is below it. So So I'm going to look, let's see, we got resistance, resistance, was some support back here, resistance, support, support. It's kind of a neutral, so that I'm also looking for, in terms of touch points, we have to also look at price, time horizon. Okay, so obviously price spent the majority of the time here at this SR level around 18, below it. So overall, I'd give it a weighted resistance price level, and close below. There is already a sell signal here, an open one back here. But this looks promising from this previous sell signal. It's already open with trailing stop up here around 19, but we broke this level, and I would give it more weighting to a resistance. Only thing I would keep an eye out for is, again, here was an obvious gap. You want to watch for those. And we, it's kind of right around, it looks like 17. Came down into that today. So that could serve as some temporary support. If that one breaks, like if we get a close below this gap high, which would be from back on March 2nd, high there was 1723, then definitely looking for this to accelerate to the downside. But it's also, it's made a big move down, but it did go below this weighted resistance, right? So, and that's why it's important to use both. Like, look at the amount of time the price spent above or below a level, because technically, even still, like, just more from an artistic versus scientific, perspective, just counting like support and resistance touches, it's kind of equal. The obvious ones here to me are resistance. Like, got much bigger moves down off this 18 level than we have gotten up off of it. So everything kind of here to me is pointing bearish below that 18 level.
All right. Let's see. Steve was first in here. He asked for Zion, Z-I-O-N.
Zion Bank, right? Yeah. All right. Sometimes you got to zoom pretty far out here. Like, now we're going back to 2020. So obviously a banking stock, it's a relatively small bank, regional bank. I think they're actually might be based out of Utah. They have a couple of branches here in Boise, where I live. So it's probably getting, killed here from early this year, where it was around the 50 level. It's gotten hammered, lost more than half of its share price. But I went back to early 2020, and so this is actually a weighted support level. Right? Because when we came down, and last time we actually came down into this level, it was a very significant rotation lower from right around the same price area, right around 50 or slightly above. So we see this again, and it resulted in a lot of buying pressure. So this to me is and not just to me, but if you look at obviously other market participants, they were buying around this level, right? Even intraday, because you see price go down to that level and breach it, and then rotate. So, yeah, to me, this is kind of a support level, but no current signals on this one. But if I were to want to trade this one, and I were to get a buy signal off of this level, I would wait for the follow through, of course, wait for the entry, and it has a good potential for a significant upside move if it makes that follow through to the upside. Could be a good opportunity. I have to keep an eye on that one.
All right. Let's see. Just
Yeah,
want to do one
maybe
more.
do one more. Yeah. And then if anyone has any kind of general questions, we can look at those too.
Okay. Just like my wife, Maria wants to visit Ulta. So can you look at ULTA?
Oh, Ulta, yeah. It's not like makeup.
Oh my gosh. My daughter goes there now. She's 7. She comes out. I'm like, what are you wearing? She'll have like blush on her face and perfume. I'm like, it's too young for that.
It's a good company though. Like definitely on a fundamental basis. I think Ulta's a great company. So yeah, I mean, looking back at like 2020, it's also like weathered the bear market really well. I mean, it's actually it did kind of range in 2022 during the bear market, but it's since bottoming back in early 2020, during the COVID sell-off, it's like made a huge run up from bottom around like 125 and trading up at 530. Great company. I mean, when you see a stock like this, like weather a bear market and like, geez, like quadruple in value, like that's huge. But it is, near highs. And so I'm always cautious of that, even if it's a great company. So it could certainly, while it could be a great long-term buy and hold on a technical basis, if I'm trading short term, I need to obviously look at these levels. So yeah, today, and there was a sell here, it was into resistance, but to me, this could be a false bearish or bullish reversal today, because it was into resistance. This is a weighted resistance level. So this is where you could get trapped if you're bullish. This could be a leg lower back into major support around 500. Now, if we get a close back above, then I can look at bullish opportunities. But this is one is a great example. Actually, I'm glad we looked at this one where I could be really cautious because it's a weighted resistance level. We broke it. And although we got a bullish reversal day into resistance, watch out for the trap. We get a close above and follow through, then we can look at potential bullish opportunities. It was a great one to end on. That's a perfect example of like where a lot of people get trapped. Yeah. So, and how to keep an eye out for that. All right. Well, those are great ones to look at. Any final questions? And then if we didn't get to yours, I apologize, but please bring it back next week. We'll do more ticker roundtable next Tuesday. In addition to some more fun stuff. And then we'll be able to look at like, okay, what happened after this week with the Fed and the debt ceiling and all these things that are causing fear in the market. We'll have more clarity around that when we meet again next Tuesday. Any final questions?
Yeah, Keith asked earlier, if you take any sort of like significance by the fact that Tesla hasn't had any sort of red or green divergence in recent memories, or anything that sticks out to you with that, or anything that kind of gives you any sort of feelings about that?
Yeah, I mean, in terms of like the divergence, typically when, because we had some bullish divergence leading up until March. So yeah, all of April. Yeah, I mean, it kind of indicates like that the directional moves aren't as strong. So like when you do see a very well-defined bullish or bearish divergence cloud, like as we did here, like back in September, is where we tend to see the really strong directional moves. So it's not to say that a directional move can't occur outside of one. We actually had one here that was quite significant, but it was out of bearish divergence. When we went into bullish divergence here, when that bullish divergence started, which is back towards the end of January, we did get a run up, and then we kind of went into a range. You can see the faintness of the divergence cloud. It's not very strong. So that's when we have a faint divergence cloud, or the absence of a cloud, is when we tend to see less dramatic directional moves. Whereas like when we get very well-defined bullish or bearish divergence, we tend to see more significant moves. So just something to kind of consider, but that might be the case.
Awesome. That's it. We have some folks that came in late. Johnny was kind of asking about the recording. We will record this, guys. It'll be available in the members area tonight, and also on YouTube the next couple of days. I'll post the link to YouTube to our page in the chat. If you guys want to grab that, you can check out more of our videos there too. So that's all I got question-wise, Jeff.
All right. Well, thank you guys so much for joining tonight. I hope you learned a lot. We'll be covering new topics next Tuesday, so I hope you can join us again next Tuesday. And you can bring your tickers. We have limited time, so we can't get to all of them every time, but we'll do our best to do those next week. We missed yours today. And keep an eye out on the Fed and those key levels tomorrow and through the remainder of the week. And look forward to seeing you guys all next Tuesday.